Welcome and thank you for joining today's event, The Anatomy of a Recession, the Post-U.S. Election Update. On your screen, you'll have the capability today to submit questions to our speaker, Jeff Solvency. Please do so when they come to you, and we'll get to them in the Q&A session. If you have any technical issues, simply refresh your browser. This will take care of most issues. I will now turn the call over to Mr. Ryan Virag from ClearBridge Investments. Ryan, the floor is yours.
Great. Thank you, John, as always, for producing another great session here with Jeff. My name is Ryan Virag. I'm a managing director and member of the global distribution team at ClearBridge. So many of my teammates have reached out to all the great folks, those of you who have dialed in today on Thursday, November 5th, to hear today's update on Anatomy of a Recession from Jeff Solvency. And in particular, we thought quite timely, given this week's news. We couldn't be more in the moment in terms of the potential effects and things that are unfolding as a result of election outcomes this week, both things that we know and some things that we may still not know but have a decent handle on. I do just want to reiterate what John said. Please participate in the polls that you'll see on your screen, and we'll make mention of those. It's always good for idea sharing amongst a group of professional buyers and institutional investors such as yourselves to get that kind of in-the-moment feedback of what your peers in similar seats are thinking. Also, after Jeff's prepared comments, we will have quite a robust Q&A session. We'll have some quick form Q&A at the beginning, kind of to up the pace a bit, and then certainly have some more robust questions and answers that hopefully leverage the input you guys put in via the chat box that hopefully you see on your screen. So I encourage you all to please submit questions, and we will attend to as many of those and answer as many of those as we can. But enough from me at this point. Really, it's always an honor, and once again today it is an honor to introduce Jeff Solvency. Many of you have heard him before. Maybe for some of you this is the first time, but he is a director and investment strategist for ClearBridge. Jeff has been with the firm since 2014, and in particular, he started developing the AOR program in 2016, which has now culminated in Jeff being a frequent contributor to print, digital, and video media, things such as the Wall Street Journal, CNBC, various blogs, and outlets on a global basis, and now to the tune of over 25,000 subscribers of the AOR content. Folks that follow that on a regular basis, many of which I think are on the line today. So thank you for that. Jeff, hand it over to you, and welcome.
Great. Thank you, Ryan, and good morning, everybody. Thank you so much for joining the Institutional Anatomy of Recession update. Obviously, we've had an election here, and it was certainly one of the most atypical presidential campaigns in modern history. I had the highest turnout in over a century, greatest share of postal voting ever, the first ever hospitalization of a candidate on the campaign trail, and probably, and I might be putting the cart before the horse here, the third ever contested election. But as it stands today, Joe Biden has 264 of the Electoral College votes. He only needs to win one more state in order to clinch the needed 270. He has a slim lead in Nevada, and most of the ballots that are coming in right now in these key battleground states are skewing mail-in ballots that usually have skewed Democratic, historically speaking. So it does appear that Joe Biden will be the next president of the United States. Nothing is set in stone, but for my comments today, I'm going to work off that general assumption. And the other general assumption that I'm going to work off of is that you're going to have a Republican Senate. Sure, the race in North Carolina, the two Georgia seats, and Alaska have yet to be called, but I do believe that a majority of those will ultimately turn Republican, keeping the Republican Senate intact. So if this outcome is ultimately what comes to fruition, a Biden win in a Republican Senate, you haven't seen this since 1988, where the U.S. has elected a new president from one party and elected the other party to run the Senate. And this combination has its pluses and minuses. Now, on the negative side is that this is the combination that's going to bring about the least in fiscal stimulus. And there's a big divide between what the Senate Republicans wanted for stimulus and what the House Democrats wanted for stimulus as well. But there was some encouraging news yesterday when Senate Majority Leader Mitch McConnell said about potentially opening a COVID relief program during the lame duck session. He said, we need to do it. We need to do it before the year. He called it a top priority. And more importantly, he did raise the possibility that a relief package would include state and local government aid. Now, this is one of the thornier issues that the House Democrats were really looking for. And I think McConnell is looking at this from a political standpoint as well. It's strong political calculus in the sense that if you look at the GOP Senate, as we move to the midterm elections, I know we just got through the general election, so looking forward to the midterm elections is maybe a little bit far out. But if you look out to 2022, there's 6 GOP senators that are either retiring or up for re-election in swing states. And a stimulus package would go a long way in order to help the U.S. economy. So my remarks really is that divided government doesn't mean zero fiscal stimulus. It just means less fiscal stimulus. And the areas where I think these two parties could come together are on further rounds of the PPP program, small business loans, and what I'm really looking for is targeted aid to the hardest hit industries, specifically hospitality and leisure. I do want them to be grants, not loans, because with COVID cases rising, a lot of these business models certainly are going to be challenged until we can get a vaccine. I think you could see some compromise on aid for the people that are unemployed and some additional, as I mentioned, state and local aid. The bills could range anywhere from the skinny package that the Senate Republicans have been talking about at $500 billion all the way up to $1.5 trillion. But ultimately, I think that package will come in at around $1 trillion to maybe $1.2 trillion, all things considered. On the other side of the equation, though, optimistically speaking, this arrangement brings about better international trade policies. I think it's going to bring about a weaker dollar, and more importantly, none of the tax increases that have been discussed with Biden's agenda gets enacted. There's going to be no major restructuring of sectors from a policy basis. This is ultimately bullish for healthcare, companies impacted by trade, companies impacted by potential tax increases. And if you look at the slide that you see in front of you, the market was pricing in a very different scenario as we led up to Election Day. So we looked at the market's performance from the first presidential debate to Election Day, and it was really pricing in that blue wave with a huge front-loaded stimulus package of anywhere from $2.5 to $3 trillion that would have given an instant boost to the U.S. economy. So naturally, in that type of economic acceleration, value would outperform growth, small caps would outperform large caps. You see inflation break-evens move higher, and then also the 10-year Treasury moved higher by 25 basis points. Now with this new divided government reality, yesterday's price action was an unwind of that trade. Growth outperformed value, large outperformed small. You saw yields come down both from inflation and break-evens and 10-year Treasuries as well. So it's unclear whether or not this trend will continue. You're seeing a lot more of a broader move in the market here today. Actually, value, as we talked just a second ago, did start to outperform growth here for the day. Again, the markets were certainly pricing a different scenario as we move to Election Day. But looking out a little bit further, there's one thing that I think is important to look at is the dollar. Usually when you get through the election, you see a dollar bounce. This is every election since 1980. Every time out of the last 10, except for one, the dollar has moved higher by an average of 2.9% in the 3 months following the election. The only outlier here was 2004. I certainly think with a smaller fiscal package likely to be enacted this time, and the fact that a lot of countries around the world and a lot of regions around the world are shutting down their economies and having to do more monetary stimulus, I think that could be a tailwind to the dollar as we get through the next quarter. But nonetheless, our core view still continues to be that you're going to have longer structural weakness for the dollar as you go through the first half of this decade. But on the plus side, volatility should likely be subsiding. And it's not uncommon for volatility to increase during election years and really spike in October and November. Investors try to reposition their portfolios in order to take advantage or align them with what the new administration's policies are likely going to be. But once you get through that November spike in volatility starts to normalize to more regular levels. And I think going forward, volatility is going to be a function of what's going to be happening with COVID. Is the economy getting closer to retrenching or shutting down? Or secondly, what's the size of the fiscal package? The larger the package, the less volatility. But again, given Mitch McConnell's comments here earlier, I am optimistic for some sort of fiscal stimulus. But the one thing I really want to hammer home here is that I don't think that the U.S. economy needs a multi-trillion-dollar stimulus package to continue to have faster than expected recovery, right? If you look at the gap between the level of labor market compensation that the market economy would have had without COVID and what we have today, the gap is only $600 billion. So that means you don't need $2.5 trillion in order to fill that gap, even if you get the skinny stimulus package that have been touted by Senate Republicans. I think that's going to go a long way in order to keep this economic momentum that we've seen with the economy moving forward. So with that, maybe I'll turn it back over to Ryan to see how people are viewing the next 3 months in the S&P 500.
Yeah, let's thank you, Jeff, for those first few slides of comments. And yes, let's unveil the results of the first poll. And it seems like the audience is positive, probably whether they're picking up on your tone, and I think the tone that will continue throughout this presentation today, or hopefully we do have quite the positive group here. But it looks like the most responded answer range is a market to finish 5% higher than we are today for the next few months, followed by 0 to 5%. So about 85% positive, only 15% any semblance of negativity, with only 5% in any kind of dramatic pullback to be expected of 5% or more. So what's your take on that, Jeff?
I'm hoping my positive tone has helped sway the results, but remember, they answered these poll questions before I even talked. So I think it's maybe the market's reaction that we've seen post-election here with very strong gains yesterday, today, and even the day before the election, that participants feel that the elections are out of the way. Now they can focus on the economy, and the economy can continue to heal on its current trajectory. And so that's exactly what our economic dashboard has been saying for quite some time. The recovery dashboard, group of 9 variables that have historically foreshadowed a durable economic and market recovery. We're trying to go from a red recession to a yellow improvement, ultimately to a green expansionary color. And we went green back in June in the second quarter, advocating to our client base to upgrade in risk, take on more beta in their portfolios because the recovery has started and economic momentum was shifting forward. And obviously, we've seen a continuation of that through to the end of October, where we currently stand. We have 7 green, 1 yellow, and 1 red signal. But more importantly, if you look throughout the course of the third quarter and into October, underneath the surface, those green variables continue to get more and more green, which gives me the confidence to say that we've reached escape velocity in the U.S. Now, one thing I want to mention here is a couple of the variables on the confidence side. The Conference Board Consumer Confidence Index is what we use for our variable. And you saw a bit of a pullback in that survey in October. The headline dropped down to 100.9, and the more forward-looking expectations component dropped back to 98.4. Now, some people would view this as a negative, but I view it as, hey, you're seeing more COVID cases in the U.S. You're likely going to see a little bit of optimism taken out of that survey. But more importantly, if you look at those numbers, these are numbers that you typically see in mid to late cycle expansions. These aren't numbers that you see at the very beginning of an economic expansion, and it's a key reason why you've seen a huge step up in large ticket purchases of homes and cars in the U.S. over the past 2 quarters. And it argues that a large segment of the population is certainly willing to take some risk right now. The other indicator that I'm going to point out here is our business confidence indicator. We look at manufacturing PMI. It's one of the best indicators out there. It really does show you inflections of the business cycle when economic growth is decelerating and accelerating. And the number that we got earlier this week blew out consensus expectations. And actually, it's the strongest headline print that we've had so far in this cycle at 59. The more forward-looking new orders component of it is a new cycle high at 67.9. So with business confidence and consumer confidence strong, again, that continues to lead to the view that you have enough momentum here in the economy to continue to move forward. Now, one of the things that was a big question mark in the middle of the summer is what was the shape of the recovery going to be? You know, I heard a lot of funny shapes out there. I heard a V-shaped recovery, a W-shaped recovery. I heard a recovery the shape of the artist formerly known as Prince, which I'm not sure how you would ever do that economically speaking. But the one question that people had, not only about the shape of the recovery, but how was the gap between financial markets and the economy going to close? A lot of people felt that it was going to be the markets that fell to catch up with the economy, but against consensus expectations, we indeed did see a V-shaped recovery. And that's probably most evident in retail sales. It only took the U.S. 6 months to regain prior highs of retail sales with the COVID crisis. If you look back to the dot-com bubble, it took 16 months to recover former highs. Global financial crisis, 34 months, so almost 3 years. And a key reason is because people made more money during this recession. Now, it's not uncommon for people to make a little bit more money during a recession, but what is uncommon is for people to make a lot more money. And you can see that the disposable income per capita on an annualized basis during the recession was up 34.2% because of the stimulus that went out to all of the Americans. And there's a lot of concerns about a fiscal cliff, and I've been talking over the last couple of months that I have not shared those concerns, right? If you look at retail sales were up 1.9% in September. That's a strong print. That is a very strong print, and this is, mind you, 2 months after the unemployment benefits from a federal perspective expired. So people continue to go out there and spend. The other thing that I like to look at is the labor market. Incomes are a very important driver of spending, and the labor market continues to heal much quicker than what was initially anticipated. This is best illustrated by the unemployment rate. The unemployment rate fell from 14.7% back in April all the way down to 7.9% in September. The total drop was 6.8% over the course of 5 months, but more importantly, we've recovered 52% of the jobs in the U.S. so far. Now, if you go back to the global financial crisis, it took 3.5 years for the U.S. to recover half of those jobs, and it took an entire decade for the unemployment rate to fall 6%. But the other reason why I'm really not concerned about a fiscal cliff is actually a survey that was put out by the New York Fed. Now, they've been doing this survey since 2013, and they ask people different questions on different months, but it's 1,300 different households, and it's nationally representative. And they asked in their June survey, how did you spend your stimulus payment? And 29% of people either spent it for non-essential or essential spending. So 29% was used for consumption, but the rest, the 71% that was remaining, was either saved or was used to pay down debt. So this is a long way of saying that people have saved for a rainy day, and it's a key reason, even if we don't get any stimulus from Congress, which is not my base case, but even if we don't, I think the economy will continue to move forward. But maybe the best illustration of the V-shaped recovery is the City Economic Surprise Index, better known as the CESI. It's a broad-based measurement of whether or not economic data is beating or missing consensus expectations. And this index made a record high by almost 3 times, so threefold to the previous record high, as the economy reopened. And that just shows you that the economic data was coming in way ahead of expectations. So thinking about this from a market perspective, obviously the first move that we saw in March of this year was because of fiscal and monetary policy. But that second leg higher that we've seen since the beginning part of the summer really has been on better fundamentals of an economy that came on way stronger than anticipated, but also earnings blew out expectations. In fact, if you look at the second quarter earnings, the surprise relative to expectations was the highest that we've seen since 1996. It beat consensus expectations. It was supposed to come in at negative 45%. It came in at negative 32%. But more importantly, if you look to this quarter's earnings season, which we're currently going through, right now, the percent of companies beating earnings estimates is 86%. If this figure holds, it's going to be a record beat on the bottom line. And the previous record, believe it or not, was set last quarter at 83%. So again, the markets weren't rewarding companies for the beats on the third quarter, but the gap that happened between financial markets and the economy wasn't closed because the markets had to sell off. It was closed because the economy was much stronger than expected and company earnings held up much better than anticipated. So obviously this is where we are now. Let's talk a little bit about the future and what to expect going forward. And I wanted to highlight a couple of concerns, right? I don't want to paint this overly optimistic picture because there certainly are concerns out there. And one of the biggest concerns that I've been talking about recently is jobless claims. If you look at jobless claims, the most recent print that we got actually this morning came in at 751,000. Now that is a much better than the peak of jobless claims that we saw during COVID of 6.9 million. But 751,000 prior to COVID would have been a U.S. record in weekly job losses. The previous record was back in 1982 at 695,000. So this can certainly signal that there's more weakness in the U.S. economy than what's showing up on the headline economic numbers. Obviously, there could be some issues with double counting and errors and some fraudulent claims. You've certainly seen this over in California. But my favorite high-frequency data point is initial jobless claims. And until I can have hard proof that maybe this number is a little bit more inflated than it should be, I got to take it at face value. So the economy, again, 5 months into reopening, is showing some signs that there are still some cracks in the foundation. But on the other end of the equation is job openings. Job openings right now are at 2018 levels, which means there's ample opportunities for the labor market to heal quicker this time than what you saw during the global financial crisis. And in fact, if you look at the chart, today's level of job openings is the highest that we've had since the series began, outside of that small period in 2018 and 2019, right? So there's ample job openings. If it was really that bad of a labor market and that bad of a situation on Main Street, you wouldn't see job openings as elevated as they are right now. So this does lead to the conclusion that the labor market can heal, again, a lot quicker than what we saw during the global financial crisis. On a separate note, quits, which are right now are at 2016 levels, it means that people aren't afraid to leave their jobs like they were last cycle. These are all good, healthy developments for the labor market. The other risk, obviously, is that winter is coming. That's for all you Game of Thrones fans out there. I'm sad that the series is over, but winter is coming, and you're seeing a new wave of COVID cases. If you look at the 7-day moving average, it increased by about 20% from last week. This morning, if you look at Wednesday's print, 102,000 new cases were reported. That is a new record in the U.S. And there's a genuine fear that obviously you're going to see lockdowns like you're seeing over in London and in Germany and France here in the U.S. But I think that lockdowns probably won't happen because of virus fatigue, right? Public support for those initial lockdown measures was fairly universal during the first wave, but it really doesn't exist right now. But also, when you had that first wave of lockdowns, it didn't succeed in permanently suppressing the virus. But the other reason why I don't think we're going to have lockdowns in the U.S. is because if you look at deaths, the mortality rate in the first wave, it moved directly higher with the number of new cases. The mortality rate has moved higher along with hospitalizations, but it is a much more measured move higher because of better treatment protocols. A lot of the new cases are in younger individuals, but also we've done a much better job of protecting the more vulnerable individuals in nursing homes and places like that. And most of the hospital systems around the U.S. right now aren't as burdened as they were back in March. So yes, it's certainly a fear and it's something that we're monitoring, but I don't think that we're going to have hard lockdowns, but you could have pockets of the economy that retrench the reopening plans a little bit and institute more social distancing types of measures. But again, I don't think it's going to derail the U.S. economy. The last risk is that although we've addressed liquidity, you have solvency issues as well. You know, if you have a fear of going out, or FOGO, as I like to say, a lot of the economy that relies on human interaction may have to rethink their business models. And it's not just restaurants, it's bars, hotels, casinos, nightclubs, pretty much anywhere where people gather in crowds. And even the best run business models can't survive on 50 or 60 or 70% of revenue in perpetuity. And if you don't have consumers that fully re-engage, a lot of these business models are no longer going to be able to survive. Now, this is where the stimulus package really comes into play. I'm really looking for targeted support to hospitality and leisure. And I think they can't be loans. I really think they need to be grants to be able to get these businesses through the hump and the new wave of COVID until we can get some vaccines into commercialization. But again, this is still one more risk that we're monitoring. But going forward, it's important to really keep that positive outlook, because I do believe that markets, and maybe more importantly, the economy, is going to surprise on the upside. So first off, on a market perspective, usually strength begets strength. And what I mean by that is the strongest 50 trading day rallies in history have usually shown a continuation of that strength. And the 50 trading day rally that we saw off of March 23rd's lows was the strongest since 1975. But if you look 12 months out, on average, the markets are up another 17.2% from the end of that rally, and they're up 100% of the time, which suggests that there's still more upside to go from this rally that we've seen. The other thing that I think is important is the Fed. The Fed has our back, and the Fed has the ability to really amp up their emergency lending facilities if they need to. So here you can see out of the $4.1 trillion in potential Fed support, they're only utilizing $124 billion of it. So if you do see any issues with COVID, any volatility, the Fed can crush that volatility or that dislocation if they need to. But on the Fed is not going to make the same policy mistake that they did back in 2015. So you see the Fed has been trying to hit a 2% inflation target over the last 15 years, and they've only successfully done that 3 times. Now they've moved to an average 2% inflation target, which means they want to average 2% inflation over a predetermined amount of time. So sometimes it's going to be above 2%, sometimes it's going to be below 2%. And the reason why, and I just alluded to it, is they made a huge policy mistake in December of 2015 when they hiked rates for the very first time. In 2015, core PCE, which is their preferred measure of inflation, was 1.2%. Nowhere close to their 2% target, but the reason why they hiked rates is because the unemployment rate was at 5%, and all of their models, which were based on the Phillips curve, said inflation is coming, you need to raise rates now because monetary policy acts with a drag. And of course, we all know that they continue to raise rates for the next 3 years, and that inflation that they were so concerned with never came. So in order to make sure that this doesn't happen again, they moved to this average inflation targeting regime. And there's really 3 things that are necessary to raise rates. One is that the unemployment level reaches what the committee constitutes as maximum employment. Now, Powell was asked what maximum employment was, and he said that he wants to see the unemployment rate get back to at least where it was pre-COVID, which was 3.5%. So 3.5% is not the floor. It might actually be lower than that. That's the first condition. The second condition is that they want to see inflation get to 2%. So they want to see it actually hit 2%. And the third is that they want to be confident that it's going to exceed 2% for some time. So what this really means is the Fed is automatically implying that they're going to let the economy run hot. They're going to have an overshoot of inflation. They're not going to raise rates until they see the whites of the eyes of inflation. And the Fed has forecasts of both inflation and the unemployment rate that goes out to 2023, better known as the dot plots. And at the end of 2023, they see inflation barely exceeding 2%, but more importantly, they see the unemployment rate only at 4%, which again is above where that maximum employment threshold is. So it's fair to say that the Fed doesn't think that they're going to raise rates until 2025 at the earliest. But right now, the Fed has a problem, right? They need to align the forecast with the target. If average inflation targeting is going to be credible, they either need to assume that the dot plots are going to be higher, or the unemployment rate is going to be lower, and that they're going to be successful in creating 2% inflation, or if not, that the level of support for the economy needs to amp up. And they're already doing forward guidance. I don't think they want to do yield curve control yet. I think the way that they do that is through quantitative easing. And the U.S. has a lot more latitude on their balance sheet for quantitative easing than the Eurozone and Japan. In fact, if the U.S.'s balance sheet was the same size as the Eurozone or the Japanese, that would mean a $7 trillion balance sheet today would be $10 trillion in Europe, $21 trillion over in Japan. But more importantly, with this stimulus package likely being the smallest out of all of the outcomes of the election, the Fed may feel like they need to do more in order to support the economy. So right now they're doing $120 billion of purchases per month. They could ramp that up. Or what they more likely will do is, instead of buying bonds on the front end of the curve, start to buy longer duration bonds, the 10-year Treasury, to keep 10-year Treasury yields low and help stimulate the economy. But the whole the whole essence of these last three slides is that even though the Fed is usually the source of the recession, they over-tighten and cause a recession inadvertently, they are not going to be a problem this time around. The Fed is only going to help the economic acceleration. The other reason why I'm optimistic about the U.S. economy is because we have a lot of shots on the vaccine goal. So we looked at the study of infectious disease vaccine clinical trial success rates from 2000 to 2015, i.e. what was your success rate of going from phase 1 to phase 2, from phase 2 to phase 3, and from phase 3 into commercialization. And what that study found is that 85% of the candidates that were in phase 3 trials made it to commercialization. And right now we have 9 COVID-19 candidates currently in phase 3 trials, which means we're likely going to have more than one vaccine approved and in commercialization in the U.S. economy in the beginning part of 2021. And on top of this, you have the personal savings rate has skyrocketed to 14.3%. This is the highest that it's been since in the mid-1970s. And in fact, the Americans have $1.2 trillion more in savings today than they did back in February prior to COVID. Now, half of that savings is due to stimulus payments. Half of it is due to reduced spending on services. But nonetheless, as a vaccine becomes more widely available, governments are going to lift restrictions. It's going to boost both consumer and business confidence. And with all this personal savings built up and pent-up demand, I very much could see a situation where you have revenge spending or deferred gratification that drives U.S. economic growth above its long-term averages. And on top of this, the inventory to sales ratio in the U.S. is at 2014 levels. If you look at autos and housing, those are at bare bottom levels. So you're going to have an inventory restocking cycle that's going to continue to drive economic activity in the U.S. And you have a very conducive macro backdrop for a strong recovery. I call it my macro trifecta. This trifecta has historically provided a boost to both businesses and consumers because of a tax cut. And the macro trifecta is lower interest rates, a weaker dollar, and reduced energy costs. Again, these are key ingredients for helping fuel an economic recovery. So if we kind of put this all together, and I'll turn it over to Ryan in just a second, but it just kind of summarized what my points are here. There really weren't any glaring structural imbalances or sizable misallocations of investment in the U.S. economy before the pandemic hit in February. And this is a completely different setup than what we found during the last recession, right? In the last recession, households and banks, they both needed to delever. They needed to work off the excesses that they had built up because of the housing bubble. And without these structural overhangs, there's a very decent possibility that you have a much faster than anticipated economic recovery. Sure, there are pockets of weakness in the economy. Some areas of the labor market that I'd like to see stronger. Jobless claims we looked at. The labor force participation rate continues to drop, which is a bit of a concern for me. But again, there's a lot of areas that are showing strength. We've talked about consumer confidence, business confidence, job openings, quits. I mean, these all point to an economy that can continue its economic momentum as we get through the fourth quarter. So looking out on the horizon, there's a lot of positive catalysts for a better than expected 2021 U.S. economic outlook. Overly accommodative Fed. I mean, the Fed is literally bending over backwards to help the U.S. economy, and they will pick up the slack if we can't get it on the fiscal side. But I do see more fiscal stimulus. The size of that package needs to be figured out, but I do see something coming down the pike. A renormalized economy due to a vaccine with revenge spending, a pretty robust inventory restocking cycle, and that macro trifecta that I talked about of lower rates, a weaker dollar, and lower energy costs. And even though historically the markets have been a little bit bumpy, I think after the election, I think given the expectation for some stimulus and that momentum that we talked about before, even if you do get a little bit of a drawdown here in the next couple of months, I think the drawdown will be manageable. And I think it's a buy the dip type of situation rather than the start of a double dip recession. And quite frankly, you know, I think I've said this 5 times already, but I do think that the U.S. economy could surprise a lot of people on the upside next year. So that's all my planned comments. Maybe, Ryan, I'll turn it back over to you to talk a little bit about the Q&A.
Excellent, Jeff. Thank you so much for covering so much ground there. And all, thank you so much. I see a number of questions already in the Q&A box. I encourage you to please do that. I thank you all for participating in the polls. There's a second left to unveil. But before we do that, and Jeff, take a quick sip of water, maybe take a stretch here. Why don't we take a handful, maybe slightly more than a handful, of some quick, what you and I call lightning round questions, really to set the table on things that can be answered, kind of with a yes, no, or with a 10-second or more, and I'm holding you to it, 10-second or less, I should say, answer, just to really kind of, as we shift gears here from prepared comments to a more interactive part of the session, and then we'll go into longer form Q&A. So are you ready?
I'm as ready as I'm ever going to be, Ryan. Let's do it.
Okay. All right, Jeff. So is the partisan balance of President, Senate, and the House what you would have expected a week ago, what we see today?
No, the markets are pricing in a blue wave.
Okay. All right. And I'm assuming that's more so in the orientation of the Senate and House, because obviously the President, we're going to be blue. With some clarity on these results that we've just mentioned, do we expect markets to react heavily to any legal challenges that may be certainly in the headlines and prolonged in the coming weeks?
No. If you look at the market reaction that we've had so far over the last couple of days, I think it's clear that there will be legal challenges, and the market has looked through that and moved higher. So, no.
Yeah, I'd say it's looked very, very much through that, given yesterday and today's market action. Will we see a robust fiscal package in the near term? If yes, when? 1 month, 3 months out, longer?
Robust, yeah, I think it'll be $1 trillion. So I'd say that's robust.
Yeah.
Even though there is some optimism on a lame duck session, I do think we're going to have to wait till Biden is inaugurated. So I would expect it in late January, which would be, roughly 3 months out from now.
Where do you see the 10-year Treasury at the end of the calendar year?
Of this calendar year or next year?
Let's do both.
All right, touche. I'm going to say this year, until there's visibility on a fiscal stimulus package, which will probably come once Biden is in presidency, I see the 10-year probably staying around 75 to 80 basis points, so I don't see much movement. As far as the end of next year is concerned, as the U.S. economy accelerates, again, with my view of above consensus growth, I think it ultimately depends on whether the Fed tweaks their QE program to buy longer duration bonds. Assuming they don't tweak their QE program, I could see the 10-year Treasury getting up to 1.5%. If they do tweak their QE program, I would imagine it's probably going to be around 1%.
Okay. Now, I know you did mention some elements of potential Fed action during your prepared comments, but what are some of the tools we may see? Is it more kind of the QE we've seen in recent years or newer tools?
Well, they certainly could do yield curve control. I mean, you've seen that over in Australia. You've seen it over in Japan, for example. Doesn't appear to be an appetite for that at the moment, but should things deteriorate, they could go down that road. They could do stronger forward guidance, which they're doing forward guidance out 3 years right now. But I think the most likely tool that you're going to see is a stronger utilization of QE. I don't think that we're going to go into a negative interest rate policy regime, even though you're seeing the potential of that over in the Bank of England right now. But I think it's going to be more QE in the near term.
Great. And last question, just yes or no, do we see, and I think you did allude to this during the remarks, the dollar versus euro, is the dollar stronger or weaker than where it is today relative to the euro, not just a global basket, but relative to the euro 6 months from now?
That's a tough question.
A lot of moving parts.
The ECB is doing more. Yeah, I know, right? The ECB is going to do a considerable amount more stimulus in December. They've alluded to that with their comments. And the economy is certainly under lockdown, so you're seeing slower growth. I would say that the dollar is weaker than the euro 6 months from now. I think we'll get through this pocket, and I think ultimately the dollar will resume its downward trends. But in the near term, it's not so clear.
And thank you, Jeff. Last one. Considering how many hours you've probably put in watching election coverage, market reactions, and by the way, congratulations on the third addition of your third child, new baby in recent weeks. How tired are you right now? You don't have to answer that, but just using that to transition. Why don't we unveil the results of the growth value poll and take that into some more robust Q&A here in the coming minutes. And all while we're unveiling this, and it looks like more people are expecting more outperformance from growth over value. Interesting. I wonder if we would have saw this numbers to this magnitude, almost 60-40, just maybe a month ago, where people were expecting a bit of a value retrace to the upside, and we probably saw over the last month. But it looks like maybe given the results from this week's elections and where the economy is, folks think growth may rule the day going forward. Jeff, what's your reaction to this, and more importantly, not just your reaction to our industry colleagues here and their answers, but your thoughts on growth versus value over the next 12 months?
Well, the one thing I'll say, and I'm going to go back about 40 slides and go to this slide, is it's not clear whether or not the price action that you saw yesterday and today is a reflection of an unwinding of this kind of blue wave scenario that people were pricing in, or it's going to be the trend that continues as we get to and through into 2021. The reason why I say that is that if you look back to 2016 in the post-election, financials screamed higher. But since then, they've been the second worst performing sector from that time frame. So it's important not to read too much into the initial results when you're right after the election. But given the fact that we do have lower stimulus expectations, and there's a lot to be found out on that front, and the increase of COVID kind of weighing on sentiment and what potential economic growth will be, I would say over the next, call it 3 months, I think it's probably going to be growth and maybe more defensively led. I think healthcare has a long way to catch up, quite frankly. But I think if you're looking at a 12-month time horizon, given all the dynamics that I said before about a U.S. economy that's going to grow stronger than consensus expectations, higher than its long-term averages, you're going to really get a reacceleration in the second and third quarter. I think that's going to be the ticket for a sustained rotation into the more value cyclical complex. And I think markets will obviously sniff that out early and likely have that transition happen in the first quarter. But the one thing that I'll mention, and it might be more of a cyclical defensive type of call rather than growth value, is financials. And I mentioned it before, but if the Fed does tweak the duration of their bond buying program and holds down the long end of the curve, it's going to hold down bank performance along with it. And if you look at growth versus value, and I actually have another slide that I forgot I had, but you'll find, Ryan and everybody, that I have a slide for almost everything. Bear with me 1 second. If you look at growth value, really it's determined by a couple of key sectors. On the value side, it's financials, then followed by industrials, utilities, energy, and materials. You look on the growth side, it's IT and consumer discretionary. But if the Fed holds down the long end of the curve, financials, even though they're very cheap, they had a blockbuster third quarter, in my opinion, financials are going to have a hard time materially outperforming if the 10-year Treasury doesn't go up along with it. And also, if 10-year Treasury yields are held down, IT, which has a 35% overweight, that lower rates generally helps growth companies that are able to grow much faster than the market overall. So ultimately, I'm going to say value will outperform growth over the next 12 months. The degree of that outperformance, in my opinion, is really going to be dictated by what happens with the Fed and the 10-year Treasury. But I do think it more of a cyclical versus defensive is the right way to try to think of this.
Great, thanks, Jeff. I do want to take you back to something. Someone is asking for some edification on the personal savings slide you spoke to earlier, and in particular the rate of 25%. Is that indeed what you're trying to say? 25% of annual income is currently the personal savings rate?
U.S. compensation, and the most recent personal savings rate is actually 14.3%. It had a high number of, I believe, 33.7 during this cycle. I can double check that in a second, but the current personal savings rate is 14.3%. But it's total compensation
right
in the U.S. What's the savings rate there?
Okay, thank you for that question from the Southwest. Another question from the audience, and folks, these are great. Please keep them coming. This is from a friend of ours in the Mid-Atlantic. Trade policy under Biden. Do we expect more protectionism and maybe the use of the term trade wars to be dominating the headlines for the next 4 plus years? Or do we expect a more positive tone and collaboration with our trading partners globally?
Yeah, I think being tough on trade is something that's bipartisan, but I think depends on which country we're talking about on how those relations are going to go. Ultimately, I think that Biden is going to restore strong ties with historic American allies, so you're going to see de-escalation, especially with Europe. But I think he's going to continue to be tough on China, and more importantly, he's going to move towards China, bringing our allies together in a more effective unilateral approach to trying to get China to change its industrial policy. I think there's going to be likely less restrictions on China. I think actually could see a retrenchment of the tariffs on China because Joe Biden on the campaign trail was saying that the tariffs were a tax on the consumer, not on China. So you could see some tariffs come off there. But again, I think being tough on China is a bipartisan issue, and I don't think things are going to get easier on the Chinese-U.S. relation front. But I think Joe Biden will be much more of a uniter in bringing a coalition to help change Chinese trade practices. So I don't see it getting easier on the Chinese front. I certainly do see better relationships with our historic allies. And the other thing that I'll just mention is that Biden has outlined ideas on moving supply chains back to the U.S., similar to Donald Trump, closing tax loopholes, and also ordering the domestic production of critical goods like medical supplies in the U.S. as well. So again, these are a lot of the same issues that the Trump administration has brought up. But overall, I really think it just matters on which region you're talking about, whether or not trade relations will get better.
Thanks, Jeff. And sticking on, kind of potential policies and posture of a Biden administration, how do you think that this outcome, so Biden entering the White House, what do you think it'll do to green energy initiatives that he's already mentioned and may even further kind of add to the robustness of those as he takes office?
Well, unfortunately, obviously, as far as his initiatives for green energy, it's going to be a shell compared to what it would have been under a blue wave. But there is bipartisan support for infrastructure spending, but, making it climate friendly doesn't necessarily change that, right? If you look at the business community, they're starting to become more vocal about green energy, being more clean. So I do think that there is going to be more bipartisan efforts in this space. But we need to realize that the initial thing that's going to happen with Congress is you're going to have to pass a comprehensive COVID fiscal package, right? Again, I think it's going to be around $1 trillion. And after that is already spent, I think it may be harder to convince Republicans to vote for another large spending bill soon thereafter. So we certainly could get some of the green initiative and some infrastructure spending. But again, I think it's going to be maybe an uphill battle in trying to get something that's meaningful in a larger type of package, all things considered. But what Biden can do is he can use his executive actions like President Trump did. He can use the Clean Air Act to regulate carbon emissions through aggressive pollution penalties. He can step up enforcement on regulations on agriculture, financial institutions to invest in fossil fuels, polluting corporations. He also can make it new permits for oil and gas extraction on federal land, very hard to get or cease altogether. And he can also said that he was going to join the Paris Agreement yet again. So, there are aspects that he can do through regulation, but as far as a specific infrastructure package, again, it's going to be how receptive the Republicans are going to be after passing a large fiscal package to help the economy out.
Great, Jeff. That's great insights. Transitioning back to maybe more comments and answers now on the broader economic recovery and how that impacts markets. We know we've and apologies if that was TMI sharing with the audience the birthday of your son. So we know you're up these days in the evenings. So we know you're up. What are you thinking about in terms of threats, or what we know it's keeping you up, but what are you thinking about in terms of the durability of this recovery, kind of in your personal time?
Yes. Obviously, a 4-month-old tends to keep you up, especially when you have the 4-month-old sleep regression, which we're currently going through. But other than that, I'm concerned about a policy mistake, quite frankly. I don't think we need a fiscal stimulus package, quite frankly, for the economy to move forward, but I think it would be very foolish not to do it. Maybe a good analogy of this is it'd be akin to putting 90% of your money or your poker chips into a hand and then folding and not sending your last 10% of chips in to win the pot, right? So I think we need I think it'd be great to have another fiscal stimulus package to be able to make sure that you continue to have that momentum until we can get to the first half of next year and you get to an economy that starts to renormalize. I don't think it's a necessity, but it's certainly obviously something that I'm really looking for. And there obviously is the chance that McConnell may retreat to conservative fiscal principles and deny Joe Biden the economic boost from a big package. That's not what McConnell said here recently, but the probability of that happening isn't zero. The other thing maybe that keeps me up at night is with the second wave that you see an increase of mortality rates. And the reason why I say that is if you look over to the Southern Hemisphere, when they had their winter here recently, you saw a couple of individual countries that had cases and deaths rise together. You saw South Africa, Argentina, and you saw it in Australia as well. Now, it was only the first wave for South Africa and Argentina, so they had never dealt with COVID before. But also in Australia, you actually saw this was their second wave, and the mortality rate actually grew just in line with cases. So it could be the individual characteristics of those countries, like maybe a poor healthcare system or a relaxed attitude towards protecting the older, more vulnerable populations. But again, this is something that bears mentioning, and it's a risk that maybe COVID in winter seasons it creates a higher mortality rate. And if that certainly is the case, again, I think lockdowns potentially for the U.S. would be a higher possibility, even though we do have virus fatigue right now. But again, what we've seen so far with this outbreak has shown that mortality rates haven't risen that dramatically. But thinking about it from a different vantage point, we're relatively early into our fall/colder season here in the U.S.
Thank you, Jeff. I just want to remind everyone there is 5 minutes left till we get to the hour mark on the call today. So please keep submitting questions. We thank you so much for joining this call today, and we're going to hope to finish here on a strong note, and we're going to do so by sticking with the markets. And I've seen a few of these come across from various questions of a similar vein from various participants today, and I'm just going to boil it down very simply for you, Jeff, right now. Are multiples too expensive, especially given the market action we've seen just in the last 36 hours?
Well, if you think back to Monday, I mean, we could go back another 60 hours. The markets have been on fire this week. Multiples aren't a good timing tool, quite frankly. They tend to lead earnings, right? It's when you come off a trough, PE multiples scream higher as the market anticipates better earnings growth, and then earnings finally catch up to multiples. So, no, I don't think the markets are too expensive from a multiples perspective. And the reason I say that, and I'm going to find a slide here if you bear with me for a second, is you can't look at the market in isolation, meaning the historic PE of the market has been 16. But today's market is way different than 1980s market, which is way different than 1950s market. And the reason why they're different is the composition of the index is different. So what we've done here in order to illustrate this point is we looked at all the cyclical sectors: financials, industrials, materials, and energy. These are sectors that ebb and flow with the business cycle. Historically, they're awarded lower PEs because of that cyclicality or lack of visibility. And then we looked at all growth, stability, and defensive areas of the marketplace. So this is pretty much everything else in the S&P 500. These are companies that either have solid business models where they have the same earnings potential in a recession or not in a recession. They have moats around their businesses. They have much higher growth rates than the market. These types of companies are usually awarded a much higher PE. And as it stands today, this is a 100-year low of cyclical representation in the S&P 500. In fact, cyclicals make up 23% of the S&P 500, while these more growth, stability, and defensive areas of the market are at 77%. So if the historic average PE of the market has been 16, maybe it should be 18, 19, maybe 20, kind of given this new dynamic and new composition. But the other thing that I think is important to take into consideration is what's the biggest other asset class for capital, or in competition of capital for equities? It's bonds, right? So what we look here is at the equity risk premium. Now, if you're not familiar with the equity risk premium, all it is you take a PE, you flip it upside down, so you put the E on top of the P. It's a way of converting a bond, a stock into a bond. It's called the earnings yield of the stock market, and you subtract that from what the 10-year Treasury is yielding. What's left over is the equity risk premium. And when the equity risk premium is above 300 basis points, it's usually a very attractive time to buy equities. And if you look to the right-hand side there, you can see the average 12-month forward excess return of the equity markets over the 10-year Treasury when you've been over this 300 basis point threshold is 12.2%. And as of the end of the third quarter, it was at 313 basis points, which suggests that equities are a lot more attractive to bonds. And I do think that there's going to be a situation as we kind of move to and through this decade with treasuries yielding so little, obviously spreads coming in quite a bit, that there's going to be a lot of investors that are going to want to move to dividend-paying equities to get their income needs and, more importantly, growth of income. And as of now, 58% of stocks right now have a dividend yield higher than a 30-year Treasury. So yes, valuations look full if you're looking at it on a historic basis. But if you take all these other factors that I've set into consideration, maybe the new normal for where equity multiples should trade is 22 or 21 or 22 or 23, given these dynamics. So no, I don't think that valuations are that stretched right now.
Awesome, Jeff. And we're broaching on the hour mark right now. So as we wrap this up, one more quick question, and you don't have to be so precise on the number, but everyone loves predictions and ranges for the market. So S&P 500 as a proxy, and we talked a little bit about it via the poll earlier in the presentation, but maybe 14 months from now, end of year 2021, and you can use ranges, but maybe what's a base case given everything you've said and today and what you expect, and potentially a bull case for the S&P 500, and you can give ranges.
Well, if there is ever such a thing as a strategist school, maybe the first lesson they teach you is that you can give people a number, and you can give them a date, but you never give them both. But with that being said, I see at least double-digit upside for the S&P 500 over the next 12 to 15 months. My bull case would probably be S&P 500 at 4,000. My bear case may be something in the 3,800 range, but nonetheless, I do see more upside as we continue to get through next year and we have a renormalization of the economy.
Wow, that's not a bear case. That's a cub. That is certainly not a grizzly bear. That is a very positive bear in base case even. Wow. So thank you, Jeff. Covered a lot of ground. Folks, thank you for calling today and listening to Jeff's comments and participating in the Q&A. Should you have any additional questions, please reach out to your ClearBridge contact. and we'd be happy to answer, to provide you more context, and potentially even get you in touch with Jeff and Josh and other folks on the team who work with Jeff and can really elaborate further even on the tremendous amount of work that Jeff and his team do with the AOR program and the broader market commentaries. So thank you all. Thank you, John, for producing another session. And as always, thank you, Jeff, for your comments. Jeff, any parting words?
No, I'd say stay invested, and in any market volatility, you should use to buy the dip, because I'm very optimistic on what 2020 will bring. But again, thank you everybody for joining, and hope you have a great rest of the week.
Thank you.
Today's call has concluded, and you may now disconnect.